Thank you for coming all the way from New Zealand to join me for this interview. Now, I want to start by asking you about the last meeting. You are clearly tilting towards higher rates. You are definitely signaling there's more to go. Just how aggressive do you think you might have to be? Or are you willing to go? Because, for example, your Deputy Governor, Christian Hawkesby, just told Bloomberg News that 4%, maybe 4.25%, it seems like you're saying the door's open.
Yes, we've been trying to get back to a position where we can be more data-driven again, rather than, the rush back to north of neutral. We know we had to slow the economy. We knew we had to be, at 3% or plus to even begin that slowing journey. And so now, really, we're in a much more comfortable position. We think, there'll be at least, another couple of rate hikes. But then we hope to get in a position where we can be data-driven and get back to our normal position of watching, worrying and waiting.
Okay. What are you watching, waiting, worrying the most?
We're looking for, significant signals of inflation expectations and actual inflation declining. We're seeing the beginning of that quite strongly, so I do feel confident we're on top of it. We will have to be, cautious. We don't need to be chasing inflation all the way down just as we let it up. So we're watching for signs where we can be, one, confident we are slowing the economy, and two, confident that that is credible and feeding into inflation expectations.
You're clearly watching all measures of the economy very closely, and the consumer is one of the big drivers of any economy. We saw the retail sales for New Zealand, the yearly rate negative for the second quarter in a row. And we just saw the first quarter of GDP a little bit negative. And so now people are saying, well, retail spending is pretty important. Are we going to see a second negative quarter? The technical recession, do you think that's possible?
I mean, our core view is no, that we won't see a technical recession. There's quite a reasonable bounce back in economic activity for Q2 of this year. We need very low consumption. In fact, our outlook is for almost flat real consumption. And so, for us to see retail sales come off like that, it's not a surprise. It's a good signal that monetary policy is biting, that we're doing our work. But there are many other things that are driving the GDP figure. And our terms of trade remains very strong. Tourism is coming back into the market. The country's reopened. And, the investment, particularly in construction activity, is still very strong. So consumers will be taking a significant part of the brunt of the slowdown. Because, we're an open trading economy. Our monetary policy mostly bites on domestic spending.
A big question for, I think, all central bankers facing these big surges of inflation is, are you willing? Are you willing to push that hard? You have this little surprise on retail sales. What if things slow more quickly? What if you are heading into recession? Is that somehow a necessary evil to get inflation down?
Well, certainly slower growth is a necessary position that we have to see. That doesn't have to be negative growth. It just means that economic activity grows slower than the potential growth of the economy. And so that potential growth is a positive rate. And so we can have positive economic growth, but declining capacity pressures. The single biggest capacity pressure globally is just the shortage of labour. We can't print people. If we could make the supply side of the economy move quicker, it would be fine. We can't, so we have to constrain the demand.
Can I just pin you down on that, though? Are you willing, though? That seems to me the question for central bankers. If you have to push that hard, are you willing to do it?
I would say that pushing that hard is going to take most countries around the world very close to zero economic growth, or certainly below potential economic growth, otherwise they're not doing their job. Once you're at that level, you can see, given the uncertainty, it's likely that some countries will be printing 2 negative quarters of growth. Specifically for New Zealand at this point, we don't see that. Can you ever rule out something like that? Our projections at the moment going ahead have pretty anemic economic growth because of what we're doing.
Governor, to that point, there's some criticism that, by this aggressive rate hike cycle, you're actually disincentivising the sort of investment that perhaps is needed to try and solve those supply side issues. And for supply side issues, monetary policy is a very blunt instrument, as we've all talked about. So is that really a risk there? Are you sort of balancing and looking at, I guess, the necessary of the evils or the best of the evils that you have to choose from?
I think we are. I mean, the single biggest problem that can happen for any economy, and certainly one that New Zealand has experienced before, is high and variable inflation and a central bank that does not have credibility to control that inflation. So, you cannot have maximum sustainable employment without low and stable inflation. So that's primary target number one. The second part, though, is that on the supply side, investment is very strong. In fact, the construction sector is going through a record period of investment. I saw one local bank in New Zealand talking about a surplus supply of housing by this time next year. So that's how quickly we've gone from an unbelievable deficit through that construction period to a surplus now. The government has a significant investment portfolio ahead of itself. Like most OECD countries, infrastructure was post-World War II. There is necessary, unglamorous infrastructure investment, roading, health, education, all of the utilities. So that's in fact, the government's been waiting for a quiet period so they don't crowd out private sector investment. And also, whilst construction investment will slow, the broader export sector has been very strong, and the investment there, our terms of trade, the regional parts of New Zealand have done very well over the last 2 years.
To that point, do you worry a little bit more now about the weakness from China, not just sort of the stabilisation measures that we're seeing, but the fact that even after the Congress, after this year, we're setting up for a period of structurally, normalised lower growth and lower demand?
Yes, so, in our projections we see, the labour market, employment growth remains positive, but we see unemployment rising. And so what we're saying is the labour force is coming back in, our borders are reopened, our net immigration will be positive, so there'll be a lot of supply side impetus to the economy. The other part, of course, is productivity, and that has been very weak. We need the investment, we need the technology, we need to be doing the same thing better or better things, operating smarter. So there's a lot of incentives there for firms to invest. The last 2 years, living in lockdown, I would say the advantages of technology really have come home. New Zealand's shown it can still sell to the world even without leaving home very well, and a lot of adaptation is happening. So it's been, I think we're in a pretty strong position. We've got employment near maximum, above maximum sustainable employment, the inflation demon, we're getting on top of that, net immigration is starting to rise again. You're seeing a more balanced environment ahead.
Now, the Federal Reserve, especially in focus here in Jackson Hole, they have signaled they're going to keep raising rates. The door is open to 50 or 75. Does it push? And what does this mean for the RBNZ? What does it mean for the markets, bond spreads, yield spreads, exchange rates? Is it something that puts more pressure on you? How do you deal with that?
I think it's, fortunately in my position, we have a floating currency. So that is a lot easier when you're dealing with a floating exchange rate. It will absorb a lot of the differences that's happening between country A and country B. But without doubt, the drive back towards the US dollar, the strength of the US dollar, has put capital outflows, a lot of strains on a lot of our trading partners. If you're a country with a managed exchange rate or a fixed exchange rate, the stronger the US dollar, the higher the interest rates, the larger the capital exit from those countries, the more they have to intervene to manage their exchange rate, the more reserves that are being spent to do that work. So, the impact is almost second-fold for us. It's not, yes, there's the direct exchange rate effect and higher imported prices, but for us it's more about what is the impact on major trading partners of New Zealand, China, Malaysia, Indonesia, Hong Kong, these our region of the world. And, when you're lifting interest rates just to maintain your exchange rate, that puts a lot of pressure on foreign reserves and their domestic economies.
But not on you, right?
Well, on us, but indirectly.
Okay.
The exchange rate will impact quite quickly on CPI prices immediately.
Right.
But we tend to look through that and think about those secondary effects.
You just mentioned the neutral rate, and I believe you and your colleagues have mentioned something like 2 to 3% as the neutral rate. Maybe an oversimplified question: how can that be the neutral rate if your year-over-year CPI is running at 7.3%? It seems like it's still pretty negative on the real side.
Yeah, so what we're talking about is a neutral rate in equilibrium, away from business cycles, ups or downs, what would be the level of the interest rate on average through time? And if you think about that, that's some combination of real growth, real GDP, plus inflation. So a neutral interest rate of around 2 to 3% is still low, because you're only talking of real growth of 1 to 2% and inflation of 1 to 2%, some combination of that. So, we can't say that that's a particularly aggressive neutral interest rate on average through time.
Okay.
But you're right, with current CPI and current interest rates, the current interest rate that people are seeing is high in nominal terms, negative in real terms.
Governor, this is maybe a bit of an existential question, but the response to the pandemic at the start was kind of cited as being a fear of reaching a level of deflation, right? Would you say that central bankers feel more comfortable confronting inflation than the risk of deflation? And is the risk that we ultimately end up there anyway if the policy doesn't play out the way as intended?
Yes, great question. Central bankers have far much more experience dealing with inflation, fighting from high inflation to low inflation, and operating where the nominal interest rates and the official cash rates are all positive nominal terms. We know a lot about that, and whilst it's a challenge, we know how to manage that challenge, reducing demand through higher interest rates and bringing that down. The concern around deflation, and I know the Governor of the Bank of Japan is with us, they've had many decades on the other side where you're trying to increase the nominal rate of inflation to something above zero. And that is an incredibly difficult task, and that's where monetary policy tools are limited. And you have to be thinking quite creatively, as they have done over decades in Japan, to get a small positive inflation. Almost a voucher system saying, here's your voucher, if you don't spend it within the year, it's not worth anything anymore. Encouraging people to get out there and consume and spend. So we always talked about the least, what's the least worst risk. That would be slightly higher inflation at the end of this pandemic period rather than deflation. And that's where we're at now. Our core inflation, 4 to 6%. We believe we are largely at the peak of it now, and we will fight it back into 1 to 3.
Speaking of fighting back, the RBNZ was the first, major central bank to cut rates when the pandemic started. 75 basis points in one push, right? Then you start raising rates, one of the first ones to do that. One of the first ones to do 50 basis point hikes, and yet you are getting a lot of pushback, a lot of questioning, a lot of criticism. How do you respond to that? Are central banks being expected, including the RBNZ, to do more? Are people thinking this is a sort of an exact science rather than something that you have to try to do in steps? Well, what do you think for you and for other central banks after this pandemic, after surging inflation?
Yeah, so central banks need to be transparent. They need to be very open and willing to show all of their workings, how they get to where they are, and really what they are trying to achieve. I find the hardest thing for a central bank is to explain to the public what you cannot achieve. We cannot, as I mentioned before, print people. We suddenly can't expand your labour force. We can't make your health system better. We can't educate your children. But a lot of the public they say, you're government, you're part of government, you should be achieving these things. So in a sense, we're victims of our own position of being out there in the public as being a regular feature of economic news and announcements. One of the biggest challenges we've had is just around asset prices. We're targeting consumer prices. You drop interest rates, well, other asset prices start to rise. And people think that you've targeted that. You're trying to make that happen. So continued communication, willingness to explain in ways that people other than just financial market participants understand. And that is a non-trivial challenge, just to be out communicating, being transparent. But let's be frank, people are unhappy at the moment. Inflation's too high. They've been kept at home for a long time. It's been an ugly period for 2 years, and this is one of the wearing the costs of this pandemic. There was always going to be a cost. It depended on how was it going to be worn.